Okay, we are live on Oz Property Investors. We bring the big names and we have the big fun. And we were just having so much fun talking about different locations and different hairstyles. And I don't know if Jeremy's got but Jordan's got the locks. So it's going to be a big session tonight because we're going to talk about are markets, is buying the next hotspot the wrong idea? With the proliferation of sort of data and chasing that sort of in and out market, is that the thing that people, if they're going to do it, what things they need to be considering and looking at? Because there's even some examples. So if you have a market you want us to consider or look at, I'm not saying we're going to tell you to buy it or not, but we'll do a bit of, because Jeremy's got some views on the maturity of a market. So we're going to be talking about all those things. How you going, Jordan? What's happening?
Mate, I'm very good. I am the one with the locks, if you can't tell. And I was saying before, I was sitting down on the beach working on my tan, but my hair gets blonder too when I sit in the sun. So it's all for you guys.
I love it. How good's that? Like, I feel very privileged that you've gone and worked on. You almost look like you could, if you were a superhero character, you'd probably be almost a Thor. So good on you for filling in for Joe.
The first one that I got the other day was Aquaman. That was a new one that I got. I was like, I don't know if I see it. The long hair maybe, but I always get Thor.
And Jeremy, how are you going anyway? What's happening?
It's busy time. It's always a busy time, and a lot of people doing lots of different things. That's kind of just keeping up with everybody. As we all know, we've seen some major changes in lending policy, especially, and I'll name it because I'm not a broker, so I can talk about that stuff. But some major lending changes with Macquarie Bank. Kind of exiting now, not just out of lending for trust, but lending for corporate entities for residential properties altogether. So no longer will they be lending to trusts or companies for that instance. And that was done as of Friday, 31st of October. So very much a Halloween treat for all the brokers.
Yeah.
But, as I've seen this happen over nearly 20 years of investing, banks turn policy on and off like a light, depending on what type of business they want. And I think Macquarie Bank's been a darling for many brokers. Jeff, I'm sure you'll talk a little bit more about that, but it was probably one of the go-to banks for many brokers because they were quick, they were efficient, they got it. They're a merchant bank with the right people, and things just happen at click of fingers. So as one bank changes policy, there's other ones that come on board and snap up that level of work that's there.
Yeah, it was interesting because so we'll talk about, because I want to hear insights for you as well, Jordan, about are investors becoming more ambitious as well, and what sort of portfolios are they looking to build, just in aggregate, of course, rather than too much of a specifics. But it's interesting you say that, Jeremy, because as somebody who's been around the blocks a few times, you say, it's gonna happen. Like it's unusual if you're not seeing a credit policy change here and there, and I think that this was, a significant one. The way I sort of saw it is I saw maybe there would be a pullback from the market in terms of that style or that structure of lending, because maybe there was perception that banks would paint a target on their back. Or it could go the other way, where there would be sort of businesses that want that. Typically, you'll see where a bank is offering a lower rate. That's where they're sort of saying, look, we're open for business. Send us the business. We want business. And then 6 months, 12 months later, they'll say, no, we don't want any more of that stuff. They'll sort of increase their rates. They'll change their policies. So that's typically what you sort of see in the credit cycle. But before I go any further, whilst we're speaking about particularly financial products or somewhat financial products, I do this at the start now, and then we don't have to do it like 18 times. So this is general information, not taking into account your personal needs or objectives. Speak to your accountant, of which Jeremy is one. Speak to your brokers, which there's plenty of great ones out there. And Jordan as well, you offer lots of great strategy with game plans as well. So now we've covered that off.
Thanks for covering it. Jez, I'm just curious, have you seen that before in your years of investing, where a bank will just not lend to a company or a trust?
I have, yes, many times. Bank West at one stage, or ING, one of the orange ones, they've kind of taken away. I've seen a lot. I've seen postcode restrictions. I've genuinely seen banks just literally say, there's a list of 45 postcodes. We're not going to lend there no matter how good the deal is. And it was all brought upon from APRA. Remember, again, everyone listening, APRA are there, the Prudential Regulatory Authority. They're there to monitor the banks. They're there to make sure that we don't have a global financial crisis. And banks, they can't have a substantial amount of interest-only loans on their books. And that was one of the things that was brought in during the Royal Commission. So you will see banks, again, like Macquarie, go very aggressive. and pick up a lot of investor lending, and then their book gets too full, and APRA come in and knock on the door and say, guys, you've got too many investor loans. You now need to bring in some P&I loans as well. So I've seen a plethora of things happen. I remember when LMI stopped getting capitalised at 95%, you could literally borrow 97.5%, including LMI. When that went, the whole world was going to collapse. No one was going to buy properties. I remember that was the biggest thing. It was the biggest change to happen in lending. And it's a thing of the past. People don't even know that was a thing 10 years ago.
Yeah.
So everybody that's out there, lending in and the property market are cyclical. Banks, they just can't continue to borrow forever. They do have some constraints that were brought on by APRA, which is our watchdog and keeps our lending and our banks healthy. And you just got to have the right professionals around you. And, someone like Jeff, who is a broker and who's worked with many brokers, we've got to remember, and I think if I'm wrong, there's over 60 banks on most brokers panels. And I think there's 92 or 93 lending institutions that are out there that are registered. So there is 93 lending institutions. Brokers have up to 60 plus on their panel. One bank pulling out of, say, for instance, lending to a corporate structure, which was, quite aggressive in many circumstances. There'll be other ones that pop up, and I'm already starting to hear some other banks come into the mix of things, although quite clunky in nature, and I'm not going to share their names just yet, but your broker will definitely be able to advise you of who they are. There's some other banks now adopting similar policies to what, say, Macquarie Bank did. So it's just one of those things that comes in swings and roundabouts. You just got to have the right person who's willing to put their head in the books and look through all the various different policies that are out there and find something that's suitable for you, but also conservative enough that you don't throw hell for leather and lose everything tomorrow.
Yeah.
So it was more just like a point in time type thing. And like, as soon as their books were evened out, they would then start lending. It's not like the end of the world. Banks are never going to lend to companies and trusts again. I'm just playing devil's advocate.
Yeah, no, they definitely will. No, it's if they take away structure, they're literally trying to manipulate then tax law. So they're not going to do those things. It's all about just, again, the amount of loans that are investor loans on their books. And I'm thinking a bit of jealousy from other banks, to be fair. I think Macquarie are getting the lion's share of a lot of lending because they just understood structure. Again, a merchant bank, we've got to look at Macquarie. They haven't got physical branches that you walk into. They're not necessarily a deposit-taking institution that, walk in there and get a checkbook, essentially. They're a merchant bank. They just get it. I think that's why a lot of brokers loved them and a lot of sophisticated investors use them. Yeah.
Well said. So I'm going to introduce these two. So we're almost 10 minutes in, and we will get to. I want to talk about what are the fundamentals and why are some people starting to deviate away from that? Because yes, there may be some opportunity, but with opportunity comes risk, as with lending as well. Like if you're going to sort of color a little bit outside the lines and understand that, then you really want to know what you're getting yourself into. But so Jeremy, for way of introduction, you've got 20 plus years experience. You've been my accountant for at least 10 plus years now. You love your small, medium businesses, but you're helping, I'd say tens of thousands now of investors with your What School Should Have Taught You, which is amazing sort of podcast and great content that you got your own portfolio of 20 plus property portfolio now. Is it still 20 or you got 30 now? Where are you at?
27 properties now. Yeah. Yep.
Nice. And I think I've got 20 plus million, but I think, it's a good number. You've done a few properties in your time. And Jordan, you are I think you're at least the founder or CEO of Game Plans. What's your role at Game Plans? Founder, CEO?
I'm pretty relaxed about it. Founder sounds cool. CEO sounds formal. So whatever you're happy with.
You're one of the most renowned property experts in Australia, looking to build out those strategies and review. I think you've done probably 5,000 plus now, have you? Is it?
Yeah, I think we just ticked over 10,000, to be honest.
10,000. Wow.
Yeah.
So if you have a question about property investing or strategy, throw it in the comments, because you have with us in the midst of us. I've probably done about, let's say 200, 300 loans, maybe not that many. Maybe that's exaggerating slightly, but I've done a few. Jeremy's done probably, I reckon you've got 10,000 plus clients, at least you've helped, and Jordan's helped 10,000 plus people build out their strategy. So ask that question. You have a wealth of experience joining us tonight. So I think it would be a shame to not see a lot of questions asked, and the audience is rolling in. So thanks for that. So what I wanted to ask both of you, I'll throw it to Jordan first. And what do you sort of see as the challenges? And maybe this is a broad question. What are the challenges and changes you're seeing coming in the next 6 to 12 months around? You can talk about any part of the property market and all that sort of side of things as well.
Yeah, I think little changes like this can throw people off in terms of bank lending and everything else like that. Does throw people off, and they kind of second guess around what they're going to do. But I think the economy is really good at the moment. The economy is strong, lending strong. Rates were just put on hold, but I think depending on what happens with rates in the future. I know there was a comment about inflation as well and where that kind of goes and if they move it up or down. So I'd be watching inflation pretty closely. I generally take quite a large macro view of things. I don't try and get into the weeds and the nitty gritties and the things that change too much in and out. But there's a couple of little indicators and things that I do follow just to, make sense of what is happening to the market. Generally, when people have money, they can borrow money, they tend to buy property and the value of property goes up, and we see the vice versa when interest rates go up as well. So yeah, from a general standpoint, I mean, there's nothing too much that comes to mind over the next 6 to 12 months that's going to have a major implication. But I think it's just about watching the economy and how it performs.
Yeah. Well, what I love you talk about the macro. Like I mean, because I'm sort of probably a little bit more in the weeds, whereas you think, I suppose, about the overall. I definitely think about that as well. But I just hear day in, day out, it's quite hard for people to buy property. What are you sort of seeing as well, Jeremy? Are you seeing, because of the lack of supply, there's so many people trying to get in. What are you kind of seeing with your clients, Jeremy?
Yeah, it is. It's lack of supply. There's still not a significant amount of listings that are coming on the market. I think a couple of the links that we're going to show people today, it's going to show maybe hundreds or thousands of interested buyers, but only 50 properties on the market, driven by population increase. We've still got hundreds of thousands of migrants coming into the country, economical migrants coming into the country every year, and Labor get grilled on it quite a bit. How many houses they built, utilising the future fund that one of the greatest treasurers that the country had, Peter Costello, built up all those years ago. How many houses have been built? And I still think the answer is none. So they're not using these billions of dollars like they should, because the private sector generally is the one that builds the housing. We did have a massive public housing push in the 50s and 60s and even 70s. And they're represented by those Pizza Hut houses you see in a lot of the western suburbs with the Pizza Hut roofs. But we just haven't had a government that's built a substantial amount of public housing for a long time. So private sector's taken it over. But while immigration's still quite strong, there's going to be a significant surge in the property market, and will continue to be. And there's still lots of money floating around. I know within my client base, of clients who are business owners, investors, there's a lot of powder still on the sidelines that they haven't deployed into the market yet. And I do know that savings has dropped. The recent research that they did, savings and offset accounts have dropped, but not by a huge percentage, not as much as they thought it would when interest rates went up. So still a huge amount of money, still a huge amount of powder, and that's represented by inflation, especially for the quarter of September being up by 1.3%. Hence the reason why we didn't have a Melbourne Cup rate cut, because it would have been counter to what Michelle Bullock's trying to achieve, being the Reserve Bank Governor of Australia. So it is still a really good time. You've got affordable properties which are getting snapped up still quite quickly. And I'm seeing a resurgence of units, a massive resurgence of units. I'm not going to say the 25-story gym, all those fancy facility style of units, but your 3 or 4 level walk-up block of units built by, the old nonno or the old Greek Tatar all those years ago. They're just flying off the shelf, and they're actually getting some really good numbers. So it just goes to show people are still hunting for those really affordable properties, and could be from that first home buyer scheme that the government released as of October.
A little bit of a sneaky one, very off-field. I'm not saying go and buy in the suburb for this particular asset type. You have to understand the quality of the builds. But Lakemba in Sydney, Jeremy, I don't know if you I heard that probably on a podcast 12 or 18 months ago, and it has done like 15% plus from a very low base, like 400,000, but just the disparity. So I mean, who knows why that particular? I mean, probably just because it's affordable.
Good location too. Good location.
Yeah.
You're on one of the main arteries that take you through the inner west or to the city if you're looking to go east or west. You know, you've got
400,000 as well. They were at
Wiley Park, Roselands, Lakemba. These are all areas which, you know, you're 25 minutes from the city CBD. I think that's pretty good value. 400 grand, 500 grand.
Speaking of, I just want to bring this up, and I can sort of talk to it a little bit. I might be on the wrong platform, but why is it so hard to get a lender to finance relocating a house? It's probably because it's in the strategy itself. These are some of the kind of things that people are considering. Yes, there's the sort of more regional markets people are looking at, but it's how do I get creative in terms of improving my cash flow? And Shane, it's because it's harder to, if for whatever reason they need to repossess, how is that asset appealing to the lender? It's effectively, it's not necessarily a proper bill, but it's just, it's the risk involved in executing that strategy. If somebody wanted to do that and think about things a little bit creatively, the way I would kind of think about it is you'd say, okay, great. You'd potentially extract the equity as a future investment purpose. And then that's up to you what you then consult your accountant, do all that sort of side of things around what that looks like. But that may be a way of, restructuring the way you're thinking about your lending, because you're probably lucky to get 40 or 50% LVR in that type of asset. Are you guys seeing any of that sort of stuff happening? I'm seeing a lot of building in of like those detachable sort of place out the back of houses in my suburb, which is probably because that's where they want to build. But it's interesting. They're really trying to increase the housing supply. So some councils have given that. Are you seeing out in the Goldie, Jordan? Probably not so much, eh?
Not so much in the Goldie, no. It's definitely getting busier out here. But similar when we're talking to clients, it's a similar sort of case and story. It's harder to get lending and it's a lower LVR on those types of assets.
Yep. Nice. And so let's get into it, because I want to sort of hit the ground running somewhat with these warts and all and buying the latest hotspot. So we should probably define, what do you guys actually consider as a hotspot? Like, is it purely based on capital growth? Like, should we define, I don't know, is there a definition of a hotspot? What do you guys think about that? You go first.
Let Jordan go. This is he's seeing this every day. So let Jordan answer this one.
It's where the masses are going. It's not necessarily where the masses are going. It's generally where people are communicating or talking about a lot. So there's a lot of people that hang in groups like these, different forums online, different masterminds, all that sort of stuff. And generally there's a consensus, or there's reports that are being printed, or there's a particular suburb or name that gets thrown out there, and like everyone starts to talk about it, and it just becomes a very hot subject. And I guess that's where the whole term of hotspot starts to come through. At what point in the cycle would you consider it a hotspot? I'm not sure, but generally what I've found is if you're starting to hear about it in all these different locations, it's too late. But there is the ability to get in at the right time if you hear about it at the right time.
Yeah. That's very well defined for a thing that I think we may not many people define it. It's like, I know that Matt here from Hashtag talks about if it's X amount of growth, then I think they start to consider it, or But how do you think about a hotspot anyway, Jeremy? What do you sort of think is it purely based on the social media hype, or is it other sort of things?
Yeah, for me, it's I never focus too much on price for being a hotspot. It's always about the velocity of people that are going to that area. Because from that velocity then starts to create the simple principle of economic issues that we all face, which is low supply, high demand, and that's where prices grow, and low demand, high supply, and that's where prices increase. But for me, I'm looking at hotspots where there are genuine fundamentals to support that level of growth as a continuation. Something that's growing at 25% per annum for 2 years, 50% return over 2 years. Does it have the legs to continue to support that level of growth? And if it doesn't, I would be deeming that as a hotspot, where it potentially might be a cool spot to come in. So they're the things I like to look at. Anything that goes against the grain. I've been investing for a long time, and I think since the rise of Bitcoin and fast returns, people are expecting double-digit returns from their properties. And we'll see some mature markets where they sit in the bandwidth of how properties are supposed to perform. Your 5 to 7% return gives you your 10 to 12 years compounding effect, which effectively doubles your portfolio. And if people aren't getting 10 to 20%, then they're saying their assets are a dog and they've got to get rid of it. So the mentality's changed a lot.
Haven't you heard the latest Bitcoin is Zcash, Jeremy? But no, I run in some interesting circles. So speaking of hotspots and that sort of social, this is one that we were speaking about before the show, because I said there's a bit of interest in Hobart, or the surrounding suburbs of Hobart, Glenorchy. So I'm not saying buying Glenorchy. I've done literally no analysis apart from having a chat with the guys before. But if you look at how many properties are on the market, 49 properties available versus look at the amount of buyers, like the amount of search interest, and you're starting to see that. I imagine if you look at the trend of days on market. So is this something you'd almost start to see as an emerging hotspot, Jeremy, where people are like, okay, where's the next spot to go? Is that what you're saying?
Yeah, absolutely. And put it in perspective, right? There's a couple of forums that are pipping, Glenorchy has been the next place to invest. I'll make it very clear for anyone that's listening. There are forums out there that are saying you need to invest in Glenorchy because it's done nothing for 5 years. Hence, 2-3 weeks later, we now start to see 2,000-3,000 people looking there. And because it's been flat and down for the last 3-4 years, they're saying, oh, this is going to pop. There still needs to be market fundamentals. And while Tasmania is a beautiful place, I've been there, there still is probably less than 1 million people. And, the industry alone is not as massive. And people need to also note that Tasmania did have a big pop in the property market probably about 5-6 years ago. But what was one of the main reasons, now myself having a lot of connections and ties to people that are looking to get their permanent residency, a lot of people were moving to Tasmania to get their permanent residency quicker and get additional points because it was a regional area that wanted to have more population growth. All of a sudden, there was stack loads of people that went there and got their PR. And then as soon as they got their permanent residency, bang, came back to Sydney, Victoria and Queensland.
Yeah.
Now, there's got to still be some underlying fundamentals of why these things, if they're sustainable and can happen in the future. And, everywhere else did quite well. And Tasmania had a big benefactor in that COVID period, but it's dipped. And now this is the talking subject. And we've got 2,000 buyers that are looking there, which is a hell of a lot for a very small area.
What about this one, Jeremy? Oh, sorry, you go, Jordan. Mate, go.
I'll go back to that graph, and I think this is a really good demonstration of what Jez was talking about in terms of having 1 to 2 to 3 years worth of really fast growth. So you can see it's gone from 400K to 600K in the span of a year or two.
50% basically, yeah. I mean, that was COVID, but yeah, that's huge, isn't it?
And I mean, there might be other factors at play, 100%. But as you can see here, you essentially when you're looking at these hotspots, or we'll talk about implementing a hotspot strategy into the overall plan. But what you're doing in these scenarios is essentially getting rid of all the supply on the market because there's so much demand, ripping out supply from the market, having those driving factors come out, and you're pulling that growth forward. So that general growth that Jez was talking about being consistent over years, you're looking at the 6.8% average growth rate across Australia. Now, obviously, you want to get into better markets that are above the average. But if you just take that in consensus, that 50% growth, you're probably bringing forward 5, 6, 7 years worth of growth into 1 to 2 years. And then as you saw from that graph, there was another 4 or 5 years of stagnation. Like it essentially wasn't doing anything. And we were talking about this last week with the guys, but if, this was the stock market and you think about maybe crypto, because Jeff, you've dropped a few crypto notes in here. But as supply and demand goes up, you see that green candle go up. And then over time, as people don't want to pay as much for it, the red candle comes down. Now, luckily enough, I mean, there are some suburbs we're going to look at that kind of look something similar, but in most of these instances, we don't have that occurrence where we've got the really bad red candle where it starts to drop. But just staying stagnant is almost just as bad for 4 or 5 years if you've just pulled the growth forward. If it's part of the strategy to have that growth in your portfolio nice and early, then by all means, it's just about, well, do you want to then hold on to that property for another 5, 6, 7 years without any further growth? Or do you want to exit, get out, and rinse and repeat, do the cycle?
Yeah, well said, Jordan. I mean, that just shows the depth of both of you, Jeremy and Jordan, the depth of understanding and experience and runs on the board you've seen people do. Somebody's thrown an interesting kind of comment, and I'll throw it into a bit of a question. Glenorchy, where are the jobs? I mean, it's kind of the rougher part of town. It's where the prison, close to the prison in Tasmania. So, where I'll go with that is, how do you guys then think about the fundamentals and what's going on in these locations as well? What other things do we need to see happening in these parts to see that fundamentals, or is it purely if the masses are starting to consider it? Is it strategy based? I don't know if that's So do you guys want to see what are the fundamentals that underpin that need to follow along that you think about?
Yeah, I mean, the biggest thing for me is just understanding the owner occupier appeal, because if there's people in the area that actually want to live and buy in that area, then you're going to have that nice and sustained growth. But if you've got investors, for example, or as in the scenario that Jez was talking about people, going there to get residency and then move out, it's you're bringing out supply and then ripping out demand later. So there's no necessarily fundamentals for people to want to stay in there. And if it's all in a higher investor focus going into that market, then it's going to be hard to come out. So yeah, generally in terms of fundamentals, owner occupier demand, you really, do all the research for all the data houses that are out there. There's a ton of really good points, but you want a really solid economy. You want people that are actually living in the area, have jobs in the area, want to live near those places and have those fundamentals for the long term, rather than just getting in there for a particular reason or just investing in there for a particular reason. One of the hardest things that we do see, or that I do see, is in that instances that we saw before where the values increased by 50%, the residents that have been living there for the last 20 or 30 years, all of a sudden the values of the homes that they have lived in is increased by 50%. And if their local economy hasn't allowed them or had the pay grade or the pay increase to allow them to afford to get into these houses, then they have to start to move into the bridesmaid suburbs and the different areas that they were before if they weren't in already. So yeah, you really do need those fundamental underpinning economy to let these properties sustain their value over that time. Yeah, I agree.
I want to share something that really highlights, and we're talking for those, you look at the economic diversity, and yes, Hobart's still a capital city, but there's not a lot to the person's point, Luke Doran, he said, where's the jobs? Well, there's probably not a lot of jobs around that location in Glenorchy. The other thing that we look at and see, and this is H-tag for those playing along at home, there's heaps of, to Jordan's point. So you see here, last 3 years, almost no growth. To Jeremy's point, they'd seen little to no growth, but 7 to 10 years seen a bit of growth. To Jordan's point again, like an URSAD, so socioeconomic disadvantage of one. So there's not necessarily renters owner as well. A lot of investors are starting to get into there, like it's above 40%. And the affordability of that market, but you see the days on market, the vacancy is quite low at the moment. So despite, and stock on market, so people are soaking up. There is a lot going in there. So you look at affordability, it's like 40 years to own a property, which in a market where the URSAD is one, you sort of think, well, how are the people then sort of having to wait, the locals, the owner occupiers to go and buy it? So it's mostly investors probably that are considering this market. So
yeah, Jeremy, and based on those numbers and fundamentals, it's looking for the next wave of investors to kick that growth the next cycle. We've seen it, and I've seen it with parts of WA. I saw just substantial amount of wealth getting created, and I sold properties in WA that had doubled, if not tripled, in the space of 3 years, because I was just like, this is insane. 50 people are lining up for a property. They're all from New South Wales, and they've never seen the asset. If they never even got on a plane and went and had looked at the areas that I went and looked at back in 2019 when I was buying. So that to me was a really good time to sell, because every second person I was speaking to was buying there from New South Wales, never been there, never seen the area, and investors just kept on paying more and more. So, to add to what Jordan said, I think that's important to note, that difference between owner-occupiers and investors. But I probably will just go on the opposite side. I have made money off the back of people hotspotting areas. If enough people believe that it's going to go bonkers and enough people buying there, I will follow that herd, and I'll just have an exit strategy to say, I'm happy to make my 30%, 40% gross return, which might equate to 100% cash on cash return. I'm happy because I didn't buy there for long-term fundamental investing. I bought there to cash in on a substantial amount of people that are just pouring into the market. So Glenorchy, that's one of those areas where I know all your, URSAT scores, and I don't really look too much on that stuff personally. They're pointing to it being not really a great area for long-term fundamental growth. But I'll say, you know what? If enough people are going to buy there and they're going to increase the artificial demand of that area, I'm happy to jump in. But I'm happy also and smart enough to know that I'm ready to get out at a certain point in time.
How do you think though, Jeremy, that 30-40% growth, like you're an accountant, how do you feel about that? Because you're losing 10% when you're around 10%, and that's maybe even for some CGT. How do you reconcile yourself to knowing that you're going to lose some of that profit by selling? How do you feel about that? And how do you?
No one ever went broke making money.
But is the juice worth the squeeze though? Is I suppose what I'm interested in your thoughts.
For me, if I've made $1 and I haven't had to put a huge amount of effort into it, it's still $1 extra that I didn't have.
Fair enough.
I'm not a greedy person. I don't look at property that sometimes I've seen people get too greedy and hold and continue to hold, especially in mining areas.
Yeah.
There's a story that I share with lots of clients. There was a lady who was a great investor, and I'm trying not to give too much details away because she does watch these lives, but she bought in Emerald in 2000. So Emerald is a genuine mining town. I believe Emerald is Queensland by memory, but I could be wrong.
Yeah, it is.
Gasfields, 2001, she paid $260 for it. She was getting $1,300 a week in 2007.
Yep.
And the price went up to about 900 grand. She paid peanuts for it. And then the rent went up to $1,800 a week by 2010 during the GFC because the raw mineral sector went bonkers. She kept it. Things started to come down. She thought it would continue to go up. She ended up holding that property at a value of $300,000 for another 15 years. And there were periods of time where it went years without rent. Her problem was she extracted a lot of equity out and she had a loan on it at about 800 grand when it was worth $300,000.
Jeez, so couldn't sell him.
That was just something where, you know what, it's done incredibly well in such a short period of time. Its fundamentals are linked to gas fields at that particular stage. Sometimes you take your money and you then go put it into something that has less return, but more stable long term.
Yeah. How do you think about that from a strategy and portfolio sort of building perspective, Jordan?
Yeah, it's definitely like a newer, not so newer, it's been around for a long time, but something that we're seeing more commonly lately. And I think it's kind of driven from, if you take the analogy before of the crypto market, because Jeff, again, I'm going to quote you, but like there's this concept of like institutional money and the smart money versus retail investors, right? And as the space has grown that we're in, and there's certain players in the space that have clients that they need to buy for and everything else like that, they have the ability to be the smart money and get into these certain locations and areas. And so there's some buyers agencies that are out there that actually do really well implementing this strategy for their clients. It works well. It's worked for Jez. Like it does work. If you're happy to cop the 6% on the way in and the 3% on the way out and pay the GST, but you've still made a buck, like it's a great strategy that works to get in and out, especially if you can multiply the factor by doing a renovation or knock down a rebuild or do something in the area to go with the growth. So it really depends on, and I say this all the time, like each property within your portfolio needs to have a purpose. So if you're maybe just starting out in your portfolio and you don't really have enough cash to get started, and you can use something like the first home owners grant to get you into that first property, if it's in the right price bracket or whatever it might be, and you're looking for that play that you just really want to build equity within your portfolio nice and early so that you can extract that equity and then get into property number 2, property number 3. It's actually a really great strategy to do that if you're with the institutional money, if you're with the right people who give you the right support to do it. If you're 2 or 3 years late and that market's already had the 50% growth and now you're just trying to get in, you might be the last one in, and you might have that 4 or 5 years worth of no growth. So you really just want to time it right and move with the money. It's a strategy that we've seen work really, really well. And then you just have to have that exit strategy, right? If you're happy to have that property in your portfolio, maybe the rental yield's good and it can go from a growth play, extract the equity into a nice cash flow play. Maybe you can add the back of a granny flat and have an additional source of income or something like that. That's completely fine. Alternatively, if you maybe are constrained from a borrowing capacity perspective and you can maybe only have 2 or 3 properties within your portfolio, there might be a reason to exit completely out of that asset, cop the CGT, cop the selling costs, and then move on to the next one and move forward from there. It can be considered a riskier play if you don't know what you're doing and if you get into the market at the wrong time, but it can be a very beneficial play if you really need some quick equity to build and continue to build the portfolio.
Yeah, well said, Jordan. Well said too. Yeah, it's great to have some. I mean, we always have a lot of experience on, but it's great to have this sort of. So another thing I wanted to, another market potentially, Jeremy. I think you've spoken. This is kind of out Grampian's way because this is another market that may have some interesting dynamics happening. So you look at because you I think you called Horsham or you mentioned Horsham in one of your podcasts probably 6-12 months ago, roughly. So how do you is this a similar, that sort of hotspot, the social media hype, but it's also migration apparently going there as well. Like it's the migrants have to go to these sort of markets to fulfill their visa requirements. Is that kind of the way you think about like a Horsham in regional Victoria?
Yeah, I think it's one of the points to it. But look, it's been a talked about suburb in my career for probably over 10 years. So I'd probably call it a more mature investment regional area. When people talk about Victoria, and I'm going to rattle off some suburbs, they talk about Melton, Frankston, Geelong, St Albans, Sunshine, Craigieburn, Ballarat, Bendigo. But no one talks, when you really put your head into Melbourne itself, you've got so many other really great areas that the locals know. You've got places like Layla, Thomastown. You've got some of the buzzwords that people use like Meadowbank and Dallas. They're really rough. But then you start to look at Brunswick, really trendy areas, very similar to, a Surrey Hills type of vibe in Sydney. So the point I'm trying to make is these are areas that have been kind of tested by investors for a number of years, and you're seeing typical investor graph. Yep. It's nothing spiky. It's not a huge ramp up. It's not a dip. It's not a massive flat line. This is just a low and slow, steady movement. And if you draw point to point, you'll see a nice kind of Bollinger Band, which is what investors that invest in shares do. They kind of look for this top and bottom, and they want to kind of see the growth sit in between that band called the Bollinger Band. Yeah. When things go outside that, either too high or too low, that's when things can either spike off or come down. So It's a very solid, stable regional spot. I wouldn't call this a hotspot by any means, although buyers are picking up and more people are talking about it.
So you'd almost consider this like a mature investors market. You'd categorize as that. So it's been there, done that sort of thing. It's not something that's come out of the blue kind of thing. Is that the way you categorize it, Jeremy?
Oh, look, so there's some very older buyers agents, people that have been in the industry for probably 8+ years. This was their go-to place 12 years ago.
Look at the yield there, 5.5%. Like that's insane for Victoria. It's like you can't get yield in Victoria. It's impossible. But you just have to go outside of Melbourne, I suppose. You have to look outside of that backyard. But 5.5% yield, I can sort of see why investors are getting somewhat interested if you can get that sort of return. And yes, you have to factor in land tax and all that if you're investing. But yeah, 5.5%, that's not a bad yield. And I'm not saying buy here or don't buy it, because you're sort of seeing that, yes, it's already seen that. It's seen 10 to 15%, depending on where you bought and what you bought. But yeah, it's seen that little bit of growth. So, I mean, a little bit, but how do you then sort of say, okay, is it now starting this kind of run here? Like what are the questions you consider, Jeremy, when you're weighing this up as to whether something, is it having those boots on the ground, as Joe likes to say, conversations with the agents? Is that how you sort of want to determine what's going on there?
Yeah, I just want to know who's buying in the area. So for me, when I sell a property, I never sell based on price, because you might have an area where your property is now worth $800,000 because it's just ramped up so much. But if there's no one interested in buying your property anymore, your property's not worth $800,000. So for me, when I'm dictating when I want to sell, I want to know if there's 50 people lining up for open homes. That's when I go into an area and I say, I'm ready to sell my property. And I'm happy with the price. When I'm buying in an area where there's only 2 people turning up to an open home and the agent's calling me 10 times. That's a buying market. So I never look at price. I always look at the feeling. I want to get the consensus of who's turning up, how many offers are getting made. There was a period of time there in WA. I've never seen this ever as an investor. There were WhatsApp chats going around between real estate agents and buyers agents, and they're listing properties on there before they even hit realestate.com.
I've seen that, yeah.
And people were buying properties off buyers agents were buying properties off WhatsApp chats.
Now, that was insane.
Those properties made money. Like they were literally making 20 seconds to make a decision, regardless of the condition. People would buy it. By the time they settled, went up $50,000. And I just want to add to Jordan's point, because he talked about institutional versus retail. the institutionals are in our format, the buyers agents, and they are actually driving markets. They're buying in, using their data, and obviously it's a full-time job. So they're looking for fundamentals that they think are there. Enough more buyers agents then kind of pour in, because some have a lot of money for the research, some don't. Then the suckers are the last 20%, which drive the price up the most. So they're in the property space. I've always used this terminology. The last 20 drive the last 50. So the last 50% of growth that you'll see in that cycle actually comes from the last 20% of people that buy there. Unfortunately, those last 20% of people that buy there often lose the most. So you just, as a retail investor, and I like to consider myself that.
You're definitely not retail, Jeremy.
I don't use all the fancy hashtag and stuff with it. Mind you, they're brilliant. They're fantastic, and you need them. You definitely need them, and without them, you're going to be behind the 8 ball. But they're the things that lots of the institutional guys are using to pick the spots. Yep. Mums and dads are coattailing off the back of it, not knowing why they're doing it. They're just doing it because their friend who bought with the buyer's agent bought there 2 years ago and has made 50%. And that's that last driver of growth. So if you are doing it yourself and you are trying to follow people, you've got to really understand that time you're getting in. And like Jordan said, was that growth front loaded, or are you going to be holding the bag 5-6 years waiting for things to turn?
The same thing, again, the crypto analogy, like if you recall the last sort of 6 to 12 months, everyone's been talking about Bitcoin and like all these big institutions getting into Bitcoin. And if you've been watching the price over the last, I don't know, not even that long, week, 2 weeks, it's essentially dipped from 125 down to 100 USD. And it's the same sort of concept. If you're hearing about a hotspot or a new location that people have made 20, 30% of growth from, it might be the same. You might be the last, couple in that takes it from 120K to 150K, but then all of a sudden, not that necessarily property is going to dip, but it might be stagnant for 5 years. And ideally, that's not the outcome that you want. Yeah.
Good conversation here, guys. I wanted to bring up this point from Tim, who said all property is increasing in value and some are increasing in rent more so. I mean, not all property, I don't know. There's probably, I'm just trying to think. Is there actually property? Is there a market around Australia that's completely unloved at the moment? Probably like a Cooper Pedy. I don't know. Is a price increasing in Cooper Pedy? I don't know, maybe we should have a look at it. Or broken.
We're going to see some graphs. We're going to see some graphs of some very heavily invested areas that were hotspots 2 years ago, where they've flatlined, if anything, slight dipping occurring after receiving, 80% of growth. So yes, there are areas that aren't going to feel the love.
Let's bring up a couple now. Let's do it.
And there's also individual properties. I mean, I had a client once who had a property in Sydney CBD. It was a studio apartment. And I don't remember the exact numbers, but essentially it was valued the same that it was 2 decades ago when she bought it. And so, there's markets across the country, there's markets within markets, but there's also assets within those individual markets. And Sydney's performed really well over the last 2 decades. So, if you can imagine holding on a property for 20 years and it not performing or not doing anything, it comes down to individual assets as well.
Mm-hmm. Yeah. I remember that time we did that session on like, should you buy units, or like, is there like the house and land analysis? And you brought some examples of that session. I was like, wow, this is insane that was happening. Jeremy, do you want to we'll quickly call out some of those areas that you talked to, as in the WA ones. I'll bring them up. I'll bring up the graphs. But you suggested, and I brought up Hillman as well, which is another one which grew, which is almost tripled in the last 5 years. But Gosnells is one of those ones which we sort of see, which everybody was buying in. Joe said he hated Armadale, and he bought a few there, but he said he hated Armadale. I said, Joe, the location doesn't care whether you hate it or not. It'll still probably grow because enough people supply and demand. This
particular area, I remember, I know this area well. I bought there in early 2020, but days on market when I first bought there were around about 90. Days on market got as low from what I saw in the peaks
7 or 8.
2 or 3 days. It was like something stupid like that.
Yeah.
And now you can see days on market starting to balloon out as an average. Still a lot of buyers interested in there. But you can definitely see now that it's had a really sharp price growth from that bandwidth's actually quite big, 200 to 800. So, 250, 260 is where it started at. Very common property price in Gosnells for many years, 5-6 years, if not longer. And you can see now since the last, late 2024 all the way up to say now late 2025, we've had very little movement in price.
And you could actually, this was a capital city, so you could actually see it playing out in front of you. Like if you were tracking and actually had your nose to the ground, if you were on, I'm not saying look at forums or look at that, but you could sort of see way back here at the start of COVID or just before COVID COVID was sort of, you were seeing just under 200 sales. And then it gradually started picking up as people started to cotton on, like in the mid 200s. So it took about 6 months to get an extra 100 sales a month. And then it just really started to...
it ballooned. It started to get up to 600 sales. There was a 500 there at one stage, I think I saw.
Yeah, and even, you sort of started to see it level off here just as price is slowing down. So you could almost, and I'm not saying this is not the only metric you should look at, but it's purely almost a supply and demand, because right now, like you're seeing sales drop.
Number of sales
maybe
dropping.
month on month, and maybe that's because there's not as much stock on the market, but because we're still at almost record lows in WA. If you look at REWA stats, Real Estate Institute of WA, but yeah, you're sort of starting to see it go back to what it was here at the start of the end of as COVID was coming in. So you say, oh, look, maybe that's a bit of an indicator that, there's not as much sort of activity happening. If we look at Hillman, another one, for example, like look at this one. This has almost tripled in the last 4 to 5 years from 200. This was a suburb of Rockingham area that just people would the locals really thought it was ugly. It was like there's Coolungup and there's Rockingham, which locals around the station, they don't like it. But Hillman was like that. Oh, you're not going to Hillman, or even Kwinana around those sort of regions. But yeah, Jeremy, that's and you sort of started to see sales volume still stay stable, but that price is almost flatlining there because it's just not affordable for the.
And you see in that area prior to 2020, I guarantee you it's flat as well. Like it literally had a decade of nothingness. And then price point, became cheap, it became affordable, and the yields started to obviously blow out because prices didn't move, but natural attrition of rent started to grow. And then all of a sudden we've now seen a huge spike in price. And, well done to most people that bought there. They've done very well. That is probably something that if I was in that area, I would have exited, maybe in the last year, seen double my value, if not more. I'm out. I'm happy.
Oh, that's typical price. Yeah, look at this, Jeremy. So you're right. Look, I mean, this only goes back. I'm trying to go back longer than we'd have to look at the 10-year. Okay, let's have a look at 10 years. So yeah, look at that. It literally stayed roughly. It was around that 200 odd thousand for like back in the last perp boom. It was at 340, and then it went, and then it dips into like $250,000 for like probably 10 years. You're right. Pretty much the best part of, if we go back even further, we look at that. So it got up to about 350,000 at its absolute peak. And we're sort of looking here.
So,
it was
again, nothing wrong with what you see there, but I want to know what's driving that significant price increase. Is it investors, or is it just a substantial amount of people moving there to create a family and a life? Is it people moving there to gain permanent residency points? Tourism, what's the fundamental factor of it? Because if populations increase that much, well then why haven't we seen a gradual movement upwards as opposed to this huge pop? Because population just doesn't go there in the space of 2 years and become, 1 million people more. So I just want to find the fundamentals. But again, you'll probably find buyers agents may have stopped buying there a while ago. They've done very well for their clients. They may have started to exit some of their clients, and this is now the mums and dads who listen to their friends who bought there 2 years ago and have made hundreds of thousands of dollars, and they're just jumping in because they're seeing a price point doing it. So fundamentals, you want to know why. If investors are driving a market, good, follow it, get on the wave, maybe get before it breaks on the shore. Or if you're going to get in, just be very wary of where you're getting in and why you're getting in.
That's wild though, isn't it? 300,000 or 300,000, 2007. And then people that were, imagine selling as you started to see this big uptick here, just like 15 years later.
Most people would. They saw a little bit of growth and sold.
And then like missing out on doubling your property. Like you'd be kicking yourself, wouldn't you? Anyway, so we're going to throw to our first ad because there's much more to come. So we're going to talk about, okay, what sort of things you should be considering. We've spoken about some of them, but there's many more questions and a couple more areas. I want to hear some of the bluer chip or the more mature markets, which Jeremy talks about, where I'm not saying it's not necessarily safe houses, but we've got plenty more stuff to come. We'll be back very soon.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
We are back. So the thing, grab myself a chocolate. Goodness me. But the thing I wanted to ask was, what do you guys think about? And I know I'm asking you to pick your favorite child potentially. What do you think about the fundamentals versus short-term trading strategy that some are looking at and considering? Is there an absolute right or wrong? Is it pigeon pairing? Like we've sort of spoken about a little bit, but I want to know, give us the kind of, if somebody's building a portfolio today, where would you sort of look at? Now, I know it's goals dependent, of course, but.
Yeah, that's 100% it. It comes down to the individual's goals and their risk profile. So some people would love to just have their little nest egg, put it into a nice property, let the property do its thing over 30 years, be nice and comfortable, sit behind the scenes and let it do its thing. Other people might take a much more active strategy, and sometimes that incorporates doing renovations, maybe flipping properties, maybe getting into these little hotspot areas, getting the growth out and moving on to the next one. It's a much more active strategy. It's not necessarily riskier, and I know I said that before, but it can be in terms of if you get the timing wrong in terms of getting in and out. So when we have seen, and Jez just touched on this before, in terms of, we're in an age now where people just want their returns really, really straightforward. And I've seen some very, very successful investors literally buy 8 properties in a row that have grown 40% in the first 2 years. Like some really, really impressive portfolios built in the short amount of time. Like I get gobsmacked every time I see it.
Unreal.
It's actually wild. And hats off to them. It's worked. They've now got a $10 million portfolio that they've built in 6 or 7 years just by accumulating the right assets. Like obviously they have to have the borrowing capacity to be able to underpin that, but they've had the equity, they've built the portfolio to go from there. So it works really, really well. But on the other side, it just depends on what you want out of property. I mean, we talk to a lot of older individuals at the moment who just want to retire as soon as possible. And so their strategy isn't necessarily too focused on getting equity out of the portfolio straight away. They just want to get to a good cash flow position so that they can sustain or get into retirement a little bit earlier by having that passive income come through. So they don't necessarily fuss about chasing the latest hotspot or where's going to go well or anything else like that. They're more looking from like if I can get into this commercial asset and essentially pays for itself over 10 years, as our good friend Mr. Polisi likes to tell us, like what are the best assets I can acquire, or 2 or 3 assets that I can acquire to achieve that, to then have 150K worth of passive income and move out of my career. So it really comes down to the individual and what their goals are. But there is, as I said, a purpose for every property within the portfolio. It's about understanding who you are and what you want firstly, and then going, well, how do we get you from A to B in the most efficient way based on your risk profile?
Well said. Yeah. I think when everybody says, I've got 750K, what suburb do I buy in? And I'm like, okay. I remember when I first, it's probably the most commonly asked question on any property forum. It's like, or what is the best rate is the other commonly one that gets asked a lot. And I suppose there's similar mindsets with these people. They just want the answer. They want the quick fix, the sugar hit. And I say, well, I remember when I first bought my first property, and it was like, I want capital growth and cash flow. And it's like, great. Okay. But what is that? You need to probably dig a little bit, scratch a little bit below the surface, because if you're not thinking about the strategy behind it and where you actually want to go with it, then you kind of just get what you're given kind of thing. If you're not, and I'm sure you see that heaps as well, Jeremy, the more switched on property investors come to you with a clear plan. It's like, okay, this property, and you do it as well yourself. You said, okay, look, I'm going to get in and out of this. You know exactly what you're doing with that strategy. How did you? I want to ask you, Jeremy, a little bit selfishly. How did you actually uncover? Did you wake up when you're a 3 or 4 year old and just think, okay, here's the purpose of that property. I'm going to go buy that property when I turn 18, or did you uncover it along the way?
Oh, look, I think just a lot of financial literacy at an early age helped, no doubt about it. Saving money, and father was a big influence in the way I did save money and aggressively. I probably look back and I didn't do what I would have done. So looking back, young, no risk, no liabilities, no family, I would have gone hell for leather with Hotspots. I would have followed the trend, get the biggest wave, and ride it all the way till it crashes. As you get a bit older, you get kids and family and all those things. Now you focus less on hotspots and you want more stability. In saying that, I do still do a lot of property development, and I try to develop in hotspots because I want to get that significant uplift while building, and that's where you make some really good money, and that's where developers have made good money. Developers aren't going to buy in a cool spot and develop. They want to buy in a hotspot where there's a lack of supply, and then they're the ones that cause the oversupply issue, but they're out, so it doesn't matter. But I think, coming back younger, didn't have a plan as much. I just needed to buy something because that's what you did. As I got older, started to get more sophisticated with what I did, and then started to create a business plan for every property. So the stuff that I held for 2, 3, 4 years, did what I needed to do, moved on, and always tried to build a denominator. But my advice to young people is don't focus too much on cash flow, because you're not going to get a huge amount of cash flow from residential property. I've said it. There's a couple of other property professionals that have said it. Residential property does not make, in my opinion, a great retirement asset.
No.
It's a gateway to get to retirement, but it's not an asset you generally want to hold at retirement, because the contingent liabilities, which are the costs that haven't occurred yet, like roofs and, bricks and mortar needs to be redone, and all the normal stuff, waterproofing, it's all expensive. So use property as a tool for capital growth. If you're young, go for those hotspots, go hell for leather, go aggressive. What have you got to lose? But you're a little bit older, kids and family, and a bit more liability behind you, emotional and family liability, then you just need to be a little bit more stable, and you've got to be very careful what you're buying, because it could be a big mistake and you could lose your pants on the way out or on the way in.
Yeah, there you go. I want to, because we're going to transport ourselves to a hypothetical. Don't worry, we're not going to role play, because we've done that multiple times in Oz property history, and it usually hasn't played out well. Those who remember Scott Agate and Joe and myself trying to do a role play, it's comedic. But if growth stopped tomorrow for a decade, which I don't know, that's like Mars or something, or probably even Jupiter or Saturn, like maybe even Pluto when it becomes a planet again. But let's transfer ourselves to another planet where growth stops tomorrow for a decade. What are the and there's some locations that maybe you want to bring up, some of these locations, Jeremy, that I don't know if these are locations you were talking about, but where would you, and I'll throw to Jordan on this as well, where are some of the places you'd be considering? Probably wouldn't buy there anyway, would you?
Look, if growth stopped, I probably wouldn't be buying residential property to start with. That's my personal opinion. If growth stopped, I'd probably focus on where I can generate a level of return, and that's where I'd probably pour my pennies into commercial property market, or even other assets, alternative assets. So that's number one. But I think the biggest question is, how do you know that growth will potentially stop? And for me, there's two things that I'm looking at. I'm looking at who's coming in and buying in that area, and will it continue? And one of the biggest things that I look for, and I've said it on this channel before, is I'm looking for population increase through migration. Because Australians are only having, on average, about 1.8 children per family now.
I thought it was 1.6. Has it ticked up 0.2? Are we having more kids, are we, Jeremy?
Different data, 1.6, 1.8. But we're not replacing, we're not even replacing through births, deaths and marriages, essentially what we should be. So migration is what's driving Australia's population growth, keeping GDP healthy, and making all the governments look better than what they're actually doing. For me, if I'm seeing migration start to come down, and from 400 to 300 to 200 to 100,000 people per year, I'm actually then starting to say, well, property may start to slow down at that time. But while it's lots of economic migrants are coming in, which is a good thing because it helps in growth for the country, as long as you can house everybody, of course, efficiently and cheaply, which at the moment we're struggling with. But that will continue to drive the property market. So now I'm just looking at desirability. Where are these people going to move to when they do come here? I don't know. I'm not sure what's being told out there, but for anyone that's recently migrated here in the last 2 to 3 years, why did you choose the area that you live in now, and what were the influences for it? So if you want to put in your comments, let us know, because I don't know if many people coming from subcontinent or Asia or any other places are saying, hey, we're going to move to Glenorchy because that's the place where we want to be, because we've held that's the land of dreams. That's where you're going to make the most amount of money. So I think that also needs to be factored in. And I've seen it. I've seen people move to gain extra PR points in certain areas. So there'll be whole influx, and then they all go back to where they need to be to make more money.
Yeah. What about you, Jordan? I mean, has Jeremy just stolen all the thunder? Is there any thunder left in Thor's Molina?
Yeah, I mean, if there's no growth, it's purely cash flow. I mean, where else are you going to get a return out of the asset? You'd probably just want to have as much money come through from a cash flow position as possible. But the other sort of flip side of that, if you are buying a property and interest rates aren't too high, so well, where do you want to live? Like, if you're going to spend 10 years in an asset that's not going to grow, like let's just say commercial property doesn't grow as well, it's only bringing you in a passive income. If you had to buy an asset and you really wanted to live in somewhere that in a particular location, and it goes to Jez's point, like it's all owner occupier appeal, right? If you want to live in it, then someone else is going to want to live in it in 10 years time. So if there was no growth across the board, I just want to get into the best possible location that I would want to live for the next 10 years, have that owner occupier appeal, and then hypothetically, I'm guessing growth is going to reoccur after 10 years. Hopefully there's still demand for that asset after a 10-year period.
Yeah. Sorry, Jeff. Sorry, I just want to jump in. I want to ask Jordan a question. Jordan, what are you looking for to say that area's done its thing and it's going to have no growth? What are you looking for to say that the market's going to slow down in that area? What's the trigger point so people can look to avoid that stuff?
I think it's some of the stats that we saw before, like if the number of properties is slowing down, if the growth rates are slowing down, not everyone has the ability to have boots on the ground, but same sort of scenario you've seen before. Like I remember when Melbourne was in its peak and I was going to open homes for inspections and there was literally like 50 people walking through the door, and they had these, it was like COVID, and they had these like 15-minute segments where they had these churn and burn 50 people through the door. So it's that feel, it's that supply and demand feel. If you are going into an area and all of a sudden there's a shift over a period of 3 to 6 months where you go from 50 people wanting to go through these houses, and as you said before, real estate agents aren't even contacting you anymore. They're not even calling because they've already got 3 offers before the first person's even walked in. That's hot. If that starts to shift and now you're getting agents calling you, now there's only 10 people going through the area. Growth rates have increased by, I'd say, at least 30% in 2 or 3 years. You might start be getting to that sort of middle cycle where the retail investors are coming in and doing the last 50%. So I would just be very cautious of how hot it is and how long it's been hot for. So if it's gone from being really cold to hot in the space of 3 to 6 months, you can probably assume you're quite safe. But if it's been really hot for 18 months, I'd probably be quite cautious.
On that point, how do you think about is Brisbane its own unicorn now? Has Brisbane magically decided that it doesn't adhere to capital growth law? Because but then I suppose you throw on top of that the Olympics. Does that? I don't know if you guys, Jeremy, you've probably done this. Have you looked at? I mean, I do have a bit of spare time, but the Olympics in Sydney, it absolutely went gangbusters for quite some time. I think I could be wrong here, but I believe about 94, 95. I don't know if you've done that. And then it kind of really just accelerated even post-Olympic Games till about 2002. Does Brisbane have, I mean, I know this is like a very overarching question, but is it possible it can do similar things? Keep going.
It's a funny thing. New South Wales at the Olympics coincided with obviously the Y2K, to year 2000. We had the .com boom in 2000. Everything with the .com went from 2 cents to $50. Like literally, there were multi-millionaires. multi-millionaires being made overnight. And I remember my father telling me a story of there would be deaths he would hear, and this is a morbid story, but there would be a suicide every day in the city because people would be worth X amount of money by at 1 o'clock and would be bankrupt by when the market closed at 4 o'clock. He said it was a really weird time. So that's an interesting one, but the aftermath of the Olympics for Homebush left a stagnant market there for a very, very long time. Yeah. Like Homebush didn't move from 2003 pretty much all the way to 2014-15. Didn't move. Like
Newington and that sort of Homebush, the Homebush down sort of that Centenary Drive, like they built a whole like a bucket loads of apartments and then there was that Opal Towers is in. Yeah, just all that boom of units that they tried to reinvigorate the area by building more units. I didn't know that was a good idea, but anyway,
there will be a boom there because obviously there's going to be still a lot of infrastructure that need to build, but it's going to leave the state with a bit of a hangover and maybe a lot of infrastructure that it's cost a lot of money that may not get as much use. But again, you're buying into the hype. Whether it actually makes the property market, it's good for the property market or not, the Olympics, who cares? If enough people believe that the Olympics is going to increase the property market and everyone and every, property spruiker or property agent or buyer's agent or accountant or anyone out there tells you that it's going to continue to do well, if enough people talk about it, that's a hotspot that's happening. Ride the wave, get in, don't be afraid to get out as well.
Also, I think if it's talked about early, I think a lot of people already factor that in when they're buying from the start as well. So yes, the Olympics is coming up and it's coming up in a couple of years, but people are already aware of that. And so some of those fundamental price increases could already be built into the market. It's not like it's just going to go gangbusters as soon as the Olympics comes on. It's just something to be aware of. I think people get too worked up about the Olympics is coming, it's coming. There's going to be this big growth where they're already doing infrastructure spend. They've already talked about it's already released in the media. And so a lot of that price could already be built in.
It's like the international airport out at Western Sydney, like Badgerys Creek. Like people are still talking about, should I buy there because now there's the international airport opening in 1 to 2 years' time and the metro's built. And it's like they've been talking about that since about 2012. Like, and people that maybe even earlier, Jeremy, maybe was it 2008? I don't know. It feels like it was probably 2008. But those people that really were and there was a little bit of interesting sort of stuff going on there in the government there around that time as well about land acquisitions and all that stuff. But anyway, we won't talk too much about that. It might get censured. But this I wouldn't bring this kind of stuff up, and feel free to let it go through the keeper. But somebody's asked, have we already covered good growth areas under 700,000? Patrick, that's like a cheat question. That's like, okay, great. That's like the old, where do I buy with a budget of 700,000 on the forum? Well, it's like, well, it depends. Like, and I kind of know a little bit about Patrick. So, but do you guys are you willing to throw a dart at Australia and have an opinion? We have spoken about some areas of potential, but you need to do your own research. What are you are you giving away too much secret sauce, Jordan, if you talk about areas under 700?
Yeah, I don't necessarily do. I'm not looking in that market at the moment. We don't necessarily recommend particular areas. It's kind of down to the professionals that we work with that buy with them. But have already covered good growth areas under 700. Yeah, it's a really good question. Nothing major comes to mind actually. I think. Yeah, I can't think anything off the top of my head. I mean, I would just jump into H-Tag and do a suburb report of everything that's had, at least 6.8% growth rate historically for the last 10 years. That would be a good fundamental, and then build on the story from there.
Yeah, Jeremy, are you gonna throw any secret ones our way, or what do you reckon? Melbourne.
Yeah, I'll just throw some. Yeah, look, I think there's a resurgence of some south areas of Geelong. Your Corrios and Nor Lanes. A lot of people are looking at price points there and saying that it's at replacement or below replacement value.
It's moving for sure.
Moving. There's been a huge amount of. I'm a sucker for the south coast of New South Wales, Jeff, but there's lots of money that's been thrown at your south coast, like your Nowras and Bomaderries and stuff like that. Which are from southwestern suburbs, probably an hour and 25 minutes away with the upgraded highway that's done the bypass through Berry. So there's a lot of things in there which will which will probably have some good fundamentals for growth in those areas, because price point, people can't afford to live in Wollongong, so they're moving further south. That's Tom Panos talks about bridesmaid suburbs all the time. So 700 is tough, but if you're looking at units, there's a heap of cracker opportunities below that price in good, almost I would call them inner western suburb locations of New South Wales, Queensland, Victoria. There's a lot of opportunity. But I would be staying away from those bigger block units, a lot of headaches.
We spoke about Corio in the lead up to the show last week with you, Jazz, because you saw that it did have this big influx post-COVID with the, I suppose, move outside of the city to escape those lockdown situations that was happening there. And then it really retraced quite a bit, using stock terms deliberately. I mean, not heaps. We're talking probably 5 to 10% roughly, depending on which metric you want to look at. And now almost like a gun, or like a gun at the 100 meters of the Olympics. It's as of May this year, and I imagine it was building up from the start of the year. People were really looking there, but it started to flow through 3 to 6 months after. So so you're seeing now it's grown the best part of, I don't know, like let's say 20 to 30, so probably 6% roughly, maybe a little bit more, 8%. But yeah, it is getting super heated on the ground there, and people are. So you just have to really understand what you're buying and where you're buying as well, because there is a bit of flooding in Geelong. Here, there's not too many issues with termites there, but yeah, flooding can. So really look at your VIC plan and understand that if you think you're getting a bargain, just be a little bit careful. Understanding.
And I've bought there. I've had properties there. I bought in Geelong. I bought in Norlane and Corio in about 2013, 14, and I paid 200 odd grand for them. Actually, you know what? You should be able to see it if you go on to open up a new tab. I'll give everyone the details. I sold them.
Okay.
554. Put in. This is good. People get to see what I've done. So 554 Thompson Road, spelled THOMP. Thompson Road, Norlane.
Okay.
I think I paid 190 or 200 for it.
Look at that, Jeremy.
That was the property. It's for rent.
For rent now, $400 a week.
There you go. I sold it in 2023 for four. There you go. I bought it in 2014 for 213.
Yeah, well done.
And I sold it in 2023 for 455.
Wow.
Yeah.
And I sold it with it had a huge amount of issues, that property. Just structurally, it needed so much money to fix it.
Doesn't look like they've done much to it either, Jeremy. Like, this looks like the condition that you
it does. Probably even worse. It was bad. It was a really bad condition. I had some bad tenants that went in there.
Surely that's not up to Vic like minimum standards. That just doesn't.
It was a shocker. It was a shocker house. And for me, getting rid of it at that time, I doubled my money in 9 years, I think it was, so give or take. 9 years. We've got 4 plus 3, 7 years. Doubled my money in 7 years. And you can see there, if you go back to your graph, from 2023, it really did nothing. So if we go back to Norlane as a graph, or Corio, I think it was.
Norlane's a slightly different, but there's some other interesting markets, like really hotspots. So
I sold in 2023. So I sold in a little bit of a dip just after the peak. But it has, if I look at the time I sold it, it actually was a good decision because it's done nothing for the last couple of years.
You repurpose your funds.
Yeah. The other one was Corio. I think it was, I can't even remember, 38 Granite Parade. There you go. Let's go.
Oh, yeah, no, Granite. Yeah, 38 Granite.
38 Granite. I'll spell it for you. This is great. Get to show people. So Granault. Now, I actually had a car drive through this house. Granault, I think it was. There you go. Yeah, I had a car drive through this house. So I couldn't even find a builder to fix it. So when I'd sold it, it was a shocker property, like concrete paneling house. It was just odd.
Yeah. 440 you sold it for?
I think that was 440 I sold it for, and I bought it for 216, 226, maybe by memory. There you go, 228. 228, and I sold it for. I sold it for 440. So say I doubled my money, but a car had ran through the house, and I just couldn't find someone there to fix it. Like, it was. Hopefully, they see some photos there. It was a shocker property. That was the kitchen, a blue kitchen. But it was a great opportunity to develop. At that stage, it was COVID. No one wanted to touch it. Builders are going bust. So I made the decision to let it go. And again, nothing has happened in Corio for the last couple of years, but it's starting to pick up.
Trying to see if we can find this of a place. I'm sure you did have to probably fix it, but yeah. Anyway, that was super interesting. So what we didn't cover some of the hotter spots. Actually, we can, as long as you're okay with going. We normally try and keep these into an hour and a half these days, but we've already talked about Hillman. So Cohen, which was the hotspot of kind of 2024, 2025, it still has some momentum going, but Townsville,
Wow.
yeah.
Look at that.
Yeah,
That's crazy.
Okay, it looks big because it's kind of really gotten steeper in the last kind of 12 to 18 months.
Yeah, exactly. Last 12 months is wild.
Yeah, but you can sort of start to see it's. I mean, I think it's really starting to level because you see now 386. So if you look way back here, just at the start of end of COVID, or not end, but yeah, you sort of start to see that take a similar pattern to, and this is one of the biggest suburbs of Townsville. So you'll naturally see a good amount of sales numbers anyway, but you sort of started to see it get up into the 600. Now it didn't quite hit the 600 actually. But that's just because everything was getting, it started to really accelerate here. And I think it did hit 600. No, it didn't quite. But now you can sort of start to see those numbers drop. You're seeing if you're 500, it's even under. Now it's into the high 300s. So you're just saying it's starting to lose some of that momentum, and it'll still maybe see 10% roughly growth. Who knows? But yeah, anybody who knows Townsville, Jeremy, you've probably seen the 2010s in Townsville was pretty horrific for people. It
was a hard suburb to hold during that time. But I remember seeing Cairns. Cairns went through a bit of a boom in the mid 2000s, and then obviously tapered off quite substantially. But I think just people need to be aware of in these northern Queensland regions, there are a lot of repairs and maintenance. So you just need to make sure that you buffer that in to your property, because it's a very harsh climate. You get 100% humidity, 40-degree weather, and rain that comes from both sides.
Yvette's asked us, what are your thoughts on Macquarie stopping new lendings to trust and companies? You'll have to rewatch the first 5 or 10 minutes of the show, but effectively the only constant is change. And to me, if things weren't changing, I would be concerned, because it means that businesses aren't assessing their risk and understanding, well, how comfortable are they doing what, or the regulators aren't doing that. So I think it's probably good for hopefully a healthy market. In terms of lending market, that is. So I think it's good that they considered that and sort of said, hey, look, maybe we need to just take a step back. We've captured enough of that market share. Northern Territory, Darwin, Palmerston, Jeremy. You've been on a few podcasts talking about this, but what do you, this is insane, isn't it? Or interesting, at least, rather than insane.
Yeah, I think it doesn't really give us too much, because one of the buyers hasn't been a huge amount, but everyone's buying there. Everyone's talking about Northern Territory. It's gonna pop. It probably has popped. It is popping, but I still think it's a transactional market personally, just simply because of the amount of people that are there. But Jordan, you'd probably have a bit more to share on that type of location than I would.
I haven't Malden. Yeah, I haven't heard of it, to be honest.
Just Northern Territory as a general, I think. Maybe.
Northern Territory, yeah.
It's in the Palmerston area.
Yeah,
I can talk to you on. So my understanding now, I'm not an economist and I'm not a macroeconomist, and I don't play one on the internet. But my understanding of what goes on up there, they had and you could argue there's some fundamentals behind if you want to play devil's advocate and just purely say that it's not necessarily a more speculative market. You could say that there was a Liberal government that came into charge, and they sort of started to. The economy is somewhat improving. It's a very small economy anyway. But if you look at the numbers, the average, and I promised I'd get the graph, but it was 28% investor lending is the average in the Northern Territory, basically Darwin. It's now at about 48%. So we're seeing a lot of investors, and the yields are attractive. So the yields are attractive. It's been stagnant for 10 to 15 years. It is almost that classic, hey, look, I want to look at a market that may see that sort of the 2 to 3 year, maybe a bit longer, depending on but there's also a lot of money that's sloshing around there. They're starting to see the IPEX or the IMPEX or whatever they called that project in the late 2000s, which saw significant. I think there's LNG that's gone in, and now, Jeremy, correct me if I'm wrong. They're starting to sort of kick off that. So there is a lot of money from companies that are mining companies sloshing around the LNG, the off the shore. So there's that there, which is starting to see a little bit of people move in there and rents. So, but it's a very interesting market, and you just even sort of start to see the transactions that are coming on. You sort of look at the houses, and you sort of see back at the start of or end of COVID, or whichever way you want to look at 23, and now you're sort of seeing like it's literally starting to shoot up. So you're seeing like 3 to 4 times even 5 times the amount of transactions happening. So a lot of activity happening.
It's just amazing, Jordan, to see like 15%, 20% growth numbers. Like I never saw that 10 years ago.
Yeah, it was never a thing. Hey, like
now it's kind of like, if you're not getting it, like what are you doing with your property investing? Like you kind of just,
and it's also for some of our clients, we work with about 450 businesses across Australia. Like their clients are almost like, if you're not achieving this, then you're not up to standard. You're not up to scratch. You're not achieving what everyone else is achieving. And there's actually some buyers agents that have like a guarantee: if we don't get you X amount of growth in this first period, we'll give you your money back. It's like it's quite funny to watch, because as Jazz just said, like it's nothing I experienced 10 years ago when I first started investing.
Yeah, exactly. We'll have to throw to our final sponsor for the evening, but keep throwing the questions. There's some good ones. So Tim's asking, you make money in an area, then move on to a better area. I'll throw that to Jeremy. Like we've kind of spoken a little bit about Jeremy's strategy, but let's throw to Ad. So and it's a good one. I may make a special guest appearance. So stay tuned.
Everywhere you look, someone else is making money in property except for you. Your mate, he just bought a house. It's already gone up $100,000. There's some bloke on Facebook, he's bragging about pulling in a 7% rental yield. Meanwhile, you're stuck scrolling real estate and domain, confused as hell, and having no idea about where to start. Or maybe you're that mate that's got $100,000 in equity. You have a few properties under your belt, but you feel stuck. You're unsure about how to scale without over-leveraging and not knowing what the next right move is. So why does it feel like everyone else has some kind of secret that you're missing out on? It's because they do. There's a reason some people keep stacking properties while others sit on the sidelines stacking excuses. There's a reason why some investors buy under market value while others pay too much. There's a reason why investors know the hotspots before there's any heat. And there's a reason that some people build $150,000 in passive income while others just spend years thinking about it. And it comes down to knowledge. And that's exactly why Jeff Miles and I, Joe Tucker, created the Level Up Property course to hand you the exact step-by-step process that we've used to buy over $100 million worth of property in today's market. We've built Australia's largest property investment community with over 80,000 members, and we help everyday investors secure hundreds of thousands of dollars in equity, all without wasting years of their life trying to figure it out the hard way. Making an uneducated decision on the biggest purchase in your life is just gambling with your future.
Stop it. Get some help.
And this isn't just another how to buy property course. Let's be clear though, this course isn't free. What? And neither should it be. This is our life's work. We've spent over 100 hours each on this course alone. Oh, babe. Okay, video number 3. Number 4 with million does... Fuck. Done. We've got decades of experience, millions of dollars in deals distilled into a repeatable process that you can take away for yourself. If you're looking for free advice, there's plenty of noise out there. You can go and find that if you'd like. But if you want real, actionable, step-by-step guided process that works in today's market, then this investment is going to change everything for you. By the time that you finish this course, you will have full confidence. You'll have every tool that you need to build an amazing portfolio if you act on it, right? Which is why we have mentoring built in. So we kick you up the butt to make sure that you're kicking your goals. So the real question is, how much longer are you going to watch everyone else making money in property before you jump in and start playing the property game properly? Because the sooner you start, the sooner you start winning.
Here we go. He's back. So yeah, look. I love the vibe that we get with that. It's intimate at the moment, but we'll grow. So Jeremy, we're into Q&A, and also throw your questions for Jordan as well. He's done 10,000 sort of game plans, or his company has. I don't know if you've seen. I know Joey's absolutely smashing it there as well, helping you out. So the quadruple J's is coming at you. So Jeremy, I want to unpack your strategy in terms of because Tim's asked a great question. So you make money in an area and then move into a better area. How do you think about what is Jeremy's business plan, and what components do you unpack for those starting off?
Absolutely, always. I'll make money I started buying properties in lower socioeconomic areas. I was self-proclaimed, Logan Woodridge King at one stage in 2011. I think I met every single agent there and sent bottles of wine and bourbon and stuff like that. So I love those really cheaper areas for me early on. But I, made my money and transitioned into buying better quality properties with a stronger business plan attached to it. And my goal was never to have 1,000 properties worth $100,000 each. I wanted to have a good portfolio, a solid portfolio that was meeting my needs with as least amount of headaches. Because managing a large portfolio, my wife does such a great job. There's something happening all the time, whether it's hot water system broken, flooding issues, waterproofing issues, commercial property needs this, person paid rent twice, they want it refunded back. It is a full-time job for me. So to limit myself and the amount of hours that needs to be put in there, I want better quality properties and I want the least amount of them. I love Stephen McKnight, the way he transitioned, 150 properties and pretty much sold everything and bought, a U-Butte shopping centre that gives him more money, less headaches than what 150 properties did.
Yeah. Well said. And what is when you talk about business plan a lot? What's on the Jeremy Iannuzzelli business plan? Can you reveal that secret or not really?
Yeah, absolutely. Yeah, I've got 2 properties at the moment in the process of being built.
Okay.
I will be settling very soon in the Gosford region of New South Wales. So a little area called Narara. I like it because it's, surrounded by state forest and you've got water to the east. And the reason why I'm picking Gosford personally as an area is it's the entry point in for a lot of the younger kids, younger generation that are living in the North Shore, places like Pymble, Hornsby, Ku-ring-gai, Turramurra. These younger guys, they can't afford to buy $5 million homes that their parents have, that they've had for 40 years. But they still want to live in the north. They still want to be close to their parents, and they don't want to go, 3 hours south. So they're picking areas in that lower Central Coast region, like Gosford. And I was chatting with a builder today who lives in Carryong, which is kind of at the foot of the Gosford area, and he used to live in Hornsby. And I actually asked him, why did you move your family to Carryong? He goes, Jeremy, I could afford it, and I couldn't afford to live in Hornsby near mum and dad. So looking for those type of things, like I chose Nowra a couple of years ago because Wollongong was becoming unaffordable for the generation and they're going to move down south. So that's the longer term holds. Again, maybe 5, 6, 10 years, one cycle. And then just still looking at the commercial property. I'm always trying to park my money into really good commercial, but making my money through really good residential developments in a very tightly held area. And tell you one thing though, it's becoming very expensive to develop. The building price has kind of stagnated a bit. It's just the other costs have all started to go up. There's so much red tape now. Basic 7 is just becoming huge. Sydney Water now, they've got an infrastructure fee, which they never had before. Normally you just paid a Section 73 to create a new lot and put a new water point in essentially. Now they want this infrastructure fee, which is literally like 10, 11 grand per dwelling. It never was there before. So it's just becoming really expensive to develop, and I'm starting to, just re-look at that and see if there is actually a lot of money you can make for the effort and the cost you need to put in.
Yeah, well said, Jeremy. Jordan, I want to know what are some of because you deal with a lot of or you see a lot of investors and see a lot of professionals and everybody's great. I wanted to know what are some of the discerning questions to ask anybody you're looking or considering to engage if you're going down the professional path. What are those sort of harder sort of smart question to ask.
Yeah, I think knowledge comes from experience. So make sure that they've done it themselves. They've got a journey. They've got a story. They've had some losses. I think a lot of people, don't like to share their losses, but like ask them what their hardships are. Ask them what their mistakes were made, because everyone learns from their own mistakes. And there's plenty of people that will tell you as well. And that's part of their sales pitch, really. Other than that, I mean, experience in the industry itself, not only just investing. You probably want someone who has done a number of transactions rather than just starting out. Not that everyone starting out has less experience or anything else like that, but knows the space, knows it all. And then obviously just has the tool set, has the research, has the team behind them to help them use the tools, do the research, all that sort of stuff. And then I get this question all the time. People come to me all the time and go like, "Oh, recommend me a buyer's agent." And I never want to be biased or specific on one person individually.
100, yeah.
But what I would say is go and listen to a number of podcasts that are out there. Choose 5 of them that you resonate with their strategy, resonate with their personality, resonate with who they are. And then go and speak to each individual one of them. Get a good grasp of, are they a good fit for you? Are they going to work with you? Are they going to feel good with you? And then make a decision based on that. It's a combination of experience, knowledge, and gut feel that ultimately set you up. And we see clients move buyers agents all the time. They work with one, then work with another, and work with another, and that's perfectly fine too. But yeah, I would just do your research, your due diligence, and then find someone that makes you have a good gut feel about who you're working with.
Yeah. I think that's so important for all your professionals. Like we talk about, yes, knowledge and experience. Those are kind of the prerequisites, I think, that are very important. But it's that, can you actually work with somebody? It's not certain necessarily these days, you kind of don't do it as much, but would you go and have a beer in the pub with them? Because not everybody drinks, but it's like and you don't have to be best mates with them, but could you go and sit down and have a conversation? And actually it's like, oh, how does that sort of go with you? And do you, you don't have to be best mates. It's like a real estate agent, but it's kind of, okay, is there some sort of chemistry with that person you're going to be working with? Because you're going to have to potentially ask them some hard questions about the deals they're presenting to you, or the products they're recommending, or whatever it is. So if you don't feel comfortable doing that, or if there's not that rapport that you can feel you can have with that person, maybe that's not the professional to go with in that circumstance.
Yeah. A question that always throws buyers agent, and I probably shouldn't say this, but I always ask them, like, tell me about some of the bad deals that you've done. And if they're like forthcoming and pretty genuine about it, then they've always got you better.
Everyone's good, Jordan, mate.
You should have your best interest at heart.
Yeah. Look, I'd like to round it out on this, and the audience is growing. I reckon if we had this for another 2 hours, the audience would just keep growing. I sort of find that people start to roll. Maybe we need to start the sessions at 8, but no, 7:30 works pretty well, because we've got our Queensland audience. I shouldn't call them banana benders, and WA folks who love watching us now. But guys, I want to round out with this, because we're in the sort of throes of Christmas. What are you sort of seeing this next 6 to 12 months? Is it the same sort of stuff? It's the crystal ball. Like, I'm not expecting you to pick the next free boom locations, because look, I saw the algorithm hit there. We've got another 10 viewers when I said free boom locations. But what does it kind of look like? Interest rates, I think we probably know where they're going, maybe nowhere. But just give us a broad macro view as to what you see happening in the Aussie property market. Is it more of the same?
For me, it is. There's nothing major that I think is going to be out of the ordinary that's going to throw the markets one way or the other. We've got a pretty resilient economy. Things are going pretty well. Gold was at all-time highs last week, which, generally means if we're at all-time highs, we could be on for a downturn, but the Australian property market's been pretty resilient with those highs and lows. So nothing major that I can foresee that will come up to impact the market specifically. I never like to throw out hotspots or specific locations, because it always comes back at me.
Yeah, I did throw out something not particularly bold, but I said that, look, Townsville will probably be the prime performer, at least in terms of growth. Like, it wasn't, anybody could predict that. So it's kind of easy to say that after it's all happened. But Jeremy, are you going to chuck, because I keep seeing this word and it's a buzzword, so it's an algorithm engager, stagflation. Do you see any, like, there's a little bit, but I don't think, do you see that being a bit of a black swan. It's a term everybody uses these days, so it's overused. But do you see stagflation rearing its head in the next 12 to 18, or you don't think that's really much a risk or an issue?
Yeah, look, I think we've got some good economic policy out there, to be honest. Government spending government spending still a lot of money on public sector. I just always worry about the government because there hasn't been a huge amount of money being spent on infrastructure. No new dams and all these other things for all the population increases that we've had. We're still focusing on providing a lot of jobs. So the NDIS scheme's getting well funded. A lot of other things have been very well funded by government stimulus. And while they'll have to continue to kick that can down the road, there'll still be a bit of money sloshing around the industries. So I think very much on the same as Jordan as far as his opinion. I think we'll have see much of the same, and we'll just continue to see people pouring their money into property because there's not much else that they can do. We just haven't had, in America, they're very, very share orientated. There's a public listing every day on the in the New York Stock Exchange, the Dow Jones, and all those other things. In Australia, we just don't have it. We're just property mad as a population. And property is just one of those things that is productive, but it's where people still see a huge portion of their money go to as a store of wealth. And it will just continue to be very much the same. When the banks keep lending, more people continue to come in. Property is still going to be probably the number one performing asset in Australia.
Yeah. Look, I could throw another question, but I think that, we're at an hour 30. It's a good old Pleasy's article, and he loves to throw a cat amongst the pigeons about. But we'll save that for maybe a post chat or whatever it is. But this has been a great session. Look, I want to throw if you've gotten heaps of, I want to get, we're getting some big guests coming on the next couple of weeks, I hear, and some amazing investor stories. So give us a 5-star on Spotify, team. And Jez and Jordan, if you haven't, please listen to at least one episode and give us that 5-star, team, because it helps the algorithm, because I want to get this message out to as many people, because tonight was an amazing session with so much experience and knowledge. And we want to get these kind of conversations happening almost week in, week out with the investors and the professionals coming along as well. So thanks for your time. Jeremy, I know you're very busy already anyway, but if people want to get more of Jeremy, and somebody said, Jeremy, if you want to have a strategic accountant chat, are you taking on clients? And I think, what's the best way to reach out to Jeremy or get more of Jeremy in your life?
Yeah, always happy to have a chat. Just reach out to us on our website, pradiumpartners.com.au. You could go through the links and lock in a bit of a time. Yeah,
probably what school should have taught you is the best spot. He shares so much knowledge and wisdom there. So jump on what school should have taught you, and you're absolutely nailing it there. You're building an amazing audience. So good on you. And just thanks for being such a mentor for, I suppose, myself, and just kind of picking up the phone to me, or me picking up the phone when I'm calling you. Appreciate it. So Jordan, mate, where's the best place if people want more of Jordan in their life with game plans? What's the best spot to reach out to you?
Yeah, just shoot me an email, jordan@gameplans.com.au, or I'm pretty active on all socials, predominantly LinkedIn. So shoot me a thing on LinkedIn. And Joey and I just started a property strategy podcast. It's called the Property Strategy Podcast. So we did 10 foundational episodes on that one, just covering anything A to Z in terms of property strategy. And then Joey's just gone around the country and talked to about 20 different experts all around Property Australia in all different categories and demographics. So if you're keen to delve into more strategy-related stuff, go check it out.
Yeah, that's I'll have to. I listen to a lot of. There's a couple of podcasts that have stopped making episodes, so I have to jump in and check yours out, because I think you ask it. You keep it light and also super interesting. So it's not, people at the plaudits are sort of rolling in. Everybody's saying they're loving it. So I noticed your URL for what school should have taught you. It's still not quite. I'll have to click on the one underneath the thing. I thought you might have fixed that, but that's okay. I'll get that one. I'll get the proper one. Because it's some other channel's going to get some new subscribers. But guys, it's been an amazing session. Thank you very much for taking your time and filling in as well, Jordan. It's been a great, and thanks, and wish you guys, I'm sure we'll chat in the next couple of weeks. But have a great Christmas, New Year's if we don't. So everybody
get better soon, Joe. Get better soon, mate.
Oh, he is. Yeah. Did you see that post?
He's back at home, I think, isn't he?
Yeah. He's like, I mean, he's been on the Slack and all that, and I've been ripping him up in terms of saying stuff that we're going to do. So yeah, it's back on. He's back in the swing and loving it. So guys, as Joe says, let's go and hotspot a property, or maybe not. Let's go and do what you got to do. But that was really awkward. I butchered that one. Thanks everybody.
See you guys.